Hello, I'm Ali Reza Talebi. I help smart people like you make smarter financial decisions. Thank you for watching. I recently read The Psychology of Money by Morgan Housel, and I found it extremely relevant to personal finance, financial planning, and especially the financial lives of educated professionals. At first glance, many people assume personal finance is mostly about knowledge, understanding investments, interest rates, taxes, markets, retirement accounts, or financial formulas. But one of the major lessons from this book is that financial success is not mainly about intelligence, it's mostly about behavior. This is very important because many smart, educated, successful professionals still make poor financial decisions. Not because they lack intelligence, but because money decisions are emotional, personal, social, and deeply connected to people's identity, fear, family, ego, and expectations. In this video, I want to share my major takeaways from the book and explain how they apply to financial planning for educated professionals. The central idea of the psychology of money is simple but powerful. Doing well with money is not mainly about technical knowledge, it's about behavior. This doesn't mean knowledge is not important. For sure, knowledge matters, financial literacy matters, understanding taxes, investments, retirement accounts, all of them matter. But knowledge alone is not enough. A person can understand investing and still panic during a market decline. A person can earn very high income and still save very little. A person can understand diversification and still keep too much money in one company stock, one specific business, one property, or one professional identity. A person can understand compounding and still interrupt through impatience. A person can understand risk and still take too much of it during good times. This is why financial planning must go beyond calculations and techniques and knowledge. It must help people behave better with money. For educated professionals, this is especially important because intelligence can sometimes create overconfidence. A person may be excellent in medicine, engineering, academia, business, but still be vulnerable to emotional financial mistakes. So, what's the key message here? Smart people need good systems, not just good intentions. Highly educated professionals often have a strong income, strong credentials, and strong analytical ability. But that doesn't mean that they don't make any financial mistake. Doctors, dentists, engineers, attorneys, professors, so many of the professionals often they face complex financial lives. They may have high income, high taxes, debt, equity compensation, real estate exposure, retirement planning decisions. However, the complexity is only part of the problem. The deeper issue is behavioral. A high income professional may overspend because of lifestyle expectations. An executive may keep too much wealth in employer stock because they feel confident in the company. A physician may delay disability insurance because they are focused on income, not the risk. So, one of the most valuable roles of a financial planner is not only to provide technical advice, it is to help clients slow down, clarify priorities, manage emotions, and make better decisions. One of the most important ideas which I love in this book is that wealth is often invisible. We usually see spending, not the wealth. We see the house, the car, the vacation, the clothing, the restaurant, lifestyle, but we don't see the balance sheet. We don't see debt. We don't see savings rate. We don't see the investment accounts. We don't see the emergency reserves. We don't see the insurance gaps. We don't see whether someone is financially anxious behind all these beautiful scenes. This matters because people often compare themselves to what they can see. They see visible consumption and assume it means financial success. But someone can look wealthy and be financially fragile. Someone else can look ordinary and be quietly wealthy. For high income professionals, this lesson is very crucial. Professionals' circle can create pressures to look successful. The right neighborhood, the right car, the right school, the right vacations, the right professional image. But visible success and financial strength are not same. A practical question to ask yourself is, am I spending to look successful or am I actually building wealth to become free? Another key lesson here is that income and wealth are different. Income is what you earn, wealth is what you keep, invest, protect, and grow. Many high income professionals confuse the two. They assume that because they earn a lot, they are automatically wealthy. But remember, wealth is not created by income alone. Wealth is created when part of that income is converted into capital. That capital might include retirement accounts, taxable investment, real estate equity, business equity, cash reserves, and other productive assets. For example, a professional might earn $400,000 per year, but still he might build very little wealth if most of the income goes to taxes, housing, cars, travel, family support, lifestyle. Another professional may just earn less, okay, much less. However, it's just investing majority of the money and control fixed costs, avoid lifestyle inflation, growing the money, and so we can build up more wealth. So the question is not only how much do I earn, how much my paycheck is showing. The better question is how much of my income becomes long-term wealth. For educated professionals, this is one of the most fundamental personal finance questions. One of the most practical takeaways from the book is the importance of defining enough. I hear that a lot from my clients that I want just to make more money. I want to get a bigger house. I want to get another car. But the feeling of not enough can still be there. This is very relevant for ambitious professionals. Many educated professionals are achievement oriented. They worked hard in a school, they built careers, they earned degrees and credentials. That combination can be strengths actually. However, if ambition has no boundary, it can become financially and emotionally exhausting. Without enough, people may take unnecessary investment risk, overspend to maintain status, sacrifice health. So they might make so many incorrect decisions. Defining enough does not mean giving up ambition. It just means that knowing what level of income, wealth, lifestyle, and freedom supports the life you actually want. A practical exercise here is to calculate your baseline financial freedom number. What annual cash flow would allow you to live with autonomy, dignity, and peace of mind? What amount of emergency reserves would help you sleep well? What level of wealth would give you the flexibility to make decisions from strengths instead of fear? Once you know you're enough, you can protect yourself from endless lifestyle inflation. Another powerful idea from the book is that savings are not just delayed consumption. I remember when I was going to a school, one of the basic initial definition for saving was delayed consumption. We should be more specific. Savings by freedom, savings by options, savings by time. Savings allow you to handle uncertainty without panic. This is especially important for high income professionals. A person with a high income but low savings may still feel trapped. They may need to keep working at the same pace because the lifestyle depends on that income. But a person who saves and invests consistently actually is building optionality. They may be able to change careers, retire earlier, reduce work hours, start a business. These are all the options they are opening to themselves. Savings are not boring. Savings are power. They are quiet foundation that gives you the ability to choose. How much freedom am I buying with my income each year? Your answer depends on your savings rate, how much you earn, and how much of that earning you're actually saving. For many professionals, tracking salary is not enough. You should also track savings rate, net worth, investable assets, liquidity, debt, and passive income. Because financial freedom is built not by what you earn alone, but by what you keep and grow. One of my favorite applications from the book is this. Don't build a financial plan that only works under perfect conditions. A plan can be mathematically elegant and still fail in real life. For example, a highly aggressive portfolio may have higher expected returns. But if the client panics during a market decline and sells, the plan fails. A very low cash reserve might be mathematically efficient, but if it creates anxiety and causes poor decisions, it may not be the best option. Paying down debt much earlier may not always be mathematically optimal, but for some people, it creates peace of mind and improves behavior. So it's not just all about the numbers, the emotions matter as well. So the key here is that personal finance is personal. A good plan must be technically sound, for sure. However, it must also be emotionally livable. For educated professionals, this is very relevant because many of those professionals are analytical. They may want the perfect answer, but the perfect answer on paper is not always the right answer in their lives. The better question here is, can I actually live with this plan during a stress? If the answer is no, the plan may need some adjustments. Morgan Housel also emphasizes the importance of room for error. This is one of the most crucial financial planning principles. The future is uncertain. Markets change, tax laws change, careers change, health changes, family needs change. A financial plan that works only if everything goes perfectly is fragile. A resilient plan has margin of error. Room for error actually can include emergency reserves, conservative assumptions, umbrella liability coverage, tax diversifications. For high income professionals, this matters because the lifestyle may be expensive to maintain. If the household has high fixed costs, large debt, low liquidity, and weak insurance protection, then even a high income may not prevent financial stress. Room for error is not pessimism, it's wisdom. It says, I cannot predict everything, however, I can prepare for uncertainty. A sound financial plan should contain what if scenarios. What would happen if my income stopped, my portfolio dropped, or my expenses increased unexpectedly? If one event can seriously damage the plan needs more margin. A major lesson from the book is that long-term success often comes from avoiding ruin. You don't need to make perfect financial decisions all the time, but you do need to avoid decisions that can permanently damage the plan. This includes excessive leverage, which means just borrowing more, concentrated investments, panic selling, poor tax decisions, and lack of estate planning. For high income professionals, mistakes can become larger because the numbers are usually larger. The mortgage may be larger, the tax consequences may be bigger, the business risk might be more concentrated. So the investment decision might have higher stakes. The goal is not to look brilliant every year. The goal is to remain financially strong over a lifetime. Before major decisions, you should ask yourself, what could ruin this plan? Can I survive the downside? Is a downside temporary discomfort or permanent damage? That question actually can save people from very expensive mistakes. My final takeaway from the psychology of money is money's highest value is not a status. It should be freedom. It should be dignity, control over time. It should be the ability to make decisions without constant financial fear. A high income creates opportunity, but good behavior turns that opportunity into wealth. I invite you to review a practical checklist, which is included at the end of this video. Thank you for watching. Have a wonderful day.